Hello everyone, and welcome back to our derivatives course. So far, we've discussed futures, forwards, and call options. Today we'll focus on another important strategy, buying a put option. By the end of this lecture, you'll understand what it means to buy a put option, its features, why investors use it, and examples of how it works in practice. Buying a put option gives the investor the right, but not the obligation, to sell an underlying asset at a predetermined strike price on or before the expiration date. The buyer pays a premium to acquire this right. If the asset's price falls below the strike, the put option gains value. If the price remains above the strike, the option may expire worthless. The most important point, the maximum loss is limited to the premium paid. Let's highlight the main features of buying a put option. First, the right to sell. The buyer can sell the underlying at the strike price. Second, the premium. This is the cost of buying the option up front. Third, leverage. Puts give exposure to bearish moves with relatively little capital. Fourth, limited risk. The worst case outcome is losing the premium. Fifth, significant upside. If the underlying drops sharply, profits can be substantial. Here's an example. Suppose stock XYZ is trading at $50 and an investor fears the price will drop. The investor buys a 3-month put option with a strike price of $48, paying $2 per share as a premium. Each contract covers 100 shares, so the total premium is $200. Scenario 1. If the stock falls to $40, the option payoff is $8 per share. Subtracting the $2 premium, the net profit is $6 per share, or $600 total. Scenario 2. If the stock stays above $48, the option expires worthless, and the investor loses only the premium of $200. This example shows how puts can act like insurance against declines. So why would an investor buy a put option? For speculation. If you expect the asset price to fall, buying a put allows you to profit from that decline. For hedging, investors holding stocks or portfolios can use puts to protect themselves, just like buying insurance. For leverage, puts provide large downside exposure with smaller capital compared to short selling the stock directly. For defined risk, the maximum loss is clear from the start, the premium paid. In summary, buying a put option is a bearish strategy. It allows investors to benefit from falling prices while limiting risk to the premium paid. Puts are commonly used for speculation, portfolio protection, and leveraged bearish positions. This concludes our discussion about buying a put option. See you at the next lecture.